All right, guys. Hello, everyone. Welcome to Infinite Floating Stocks. I'm Venkat, and in this session, I'm gonna talk about options. Okay. In previous session, also, I explained you about options. Okay, with real-time examples. Okay, but in this session, I'm gonna explain you about options with stock examples, with index examples. Okay, you already know what are stocks, and you already know what is an index. Okay, so I'm gonna explain about options using stock examples and index examples. Okay, so in our previous session, we discussed about options and different types of options with real-time examples. Okay, so in this session, I'm going to explain the same options with stock examples and index examples. Okay, by taking stock or index as an example. Okay, so let's start the session. All right, these are all the contents for today's session. Okay, so I'm going to talk about what are options. Okay, and what are the different types of options. There are two types of options. Okay, so going back to derivatives, you already know that we are having four types of derivatives. The first type is forwards, second type is futures, third type is options, and fourth type is swaps. Okay, so in options, there are two types of options. Okay, so option is a derivative. Okay, but in option, we have again two types of options. Okay, I'm gonna tell you what are those two types of options and how do we use them. Okay, and yeah, I'm gonna talk about market outlook according to calls and puts. Okay, don't worry about calls and what is a call, what is a put, etc. I'm gonna talk about calls and puts in this session itself. You're gonna be very confident and you will be very familiar with. You will be. I guarantee that you will be very familiar with calls and puts by the end of the session. Okay, and I'm gonna talk about what is exercising call option and what is lapsing call option, and also I'm going to talk about exercising put option and also what is lapsing put option. Okay, here exercising is opposite of lapsing. Okay, here as well exercising is opposite of lapsing. Okay, so we should be, I mean, I'll be discussing about exercising call option and also lapsing call option. Again, I'm going to talk about exercising put option and also lapsing put option. Okay, so and finally I'll be ending the session with uh, payoff diagrams. Okay, this is very important. What are payoff diagrams and how do we look at them? How do we analyze market using payoff diagrams? Okay, I'm going to talk about payoff diagrams at the end of the session, which is very important. Okay, so payoff diagrams are very important when you're dealing with options, when you're trading options, when you're using hedging techniques. Okay, for all those things, for everything you need payoff diagram. You need to be analyzing the market using payoff diagrams only. Okay, so payoff diagrams is most important part of this session. Okay, all right, let's get into first content. What is an option? You already know. When you are entering an option contract, by paying a premium, you will get the right. Okay, if you're having the right, you can do whatever you want. Okay, if one person is having right, then the other person will have obligation. Okay, right is opposite of obligation. Similarly, obligation is opposite of right. If one person is having right, the other person will have obligation. If one person is having obligation, then the other person will have right. Okay, if you are entering an option contract, by paying a premium, you will get the right. If you're having the right, then it's like you can do anything. For example, according to our previous examples, which I have explained you, saying that farmer gonna sign an options contract on December 1st, saying that he'll be selling all his vegetables at 5,000 only on December 31st, irrespective of value of those vegetables and irrespective of the external factors. Okay, so what can happen on December 31st? If the value of the vegetable goes up to 7,000, in this scenario, if farmer is having forwards or futures option, he cannot sell them at 7,000, which is current value. Okay, he should be selling them at 5,000 only to the shop owner if he is having forwards or futures contract. But if he is signing options contract, by paying the premium, he will get the right to sell the vegetables at 7,000, which is the current market price. Okay. So by paying the premium, by signing the options contract, you will get the right. If you're having the right, then you can sell the vegetables at 7,000 only by losing the premium. Okay. So if you're unclear with these terms about premium and I mean that if you want to review about options contract with real-time examples, I'll be sending out the recorded session. You can watch it again, then come back to this session. Okay, so that it will be very clear. It will be like eye opener. This session will be like an eye opener. Uh, I mean, this session will be very clear once you are good with the previous session. Okay, so previous session I explained about options with very real time examples. Okay, this session I'll be explaining options with stock and index by taking stocks and indices as examples. Okay, all right, you already know what is an option. I just explained. Okay, so in simple words, by paying a token amount, okay, called as premium, not full amount, you can register or reserve for a product or service to be delivered on a future date at an agreed price. Okay, so when that day arrives, you can have an option whether or not to avail the benefit or service or product that you are booked previously. Okay, if you want to avail, you have to pay the agreed price and avail the product. This is called exercising the options. If you don't want to avail, you forego or lose your token amount or premium, then this is called lapsing the option. Okay, in both scenarios, premium is lost. Yes, this is the same slide from our previous session. Okay, I just put it here. Uh, I mean this slide can help you to revise that building example and car insurance premium example. I mean car insurance company example, which I have given you while explaining about options. Okay, so I just put this slide here uh, just to remember you guys about. I mean, just to remind you guys about car car insurance company example and also building example which I have given you while explaining about options in last session. Okay. Just give me a minute, guys. All right. So this is all about options in very simple terminology. Exercising options is nothing but if you want to avail, if you want to avail, you have to pay the agreed price and avail the product. This is called exercising the options. If you don't want to avail the product, you lose your token amount or premium, then this is called lapsing the option. Okay. In both scenarios, in availing the product or in losing, or if you don't want to avail the product, in both scenarios, you will be losing the premium. Okay. That is very important point of this slide. Example. Okay. Example. I'm gonna talk about the same example. Okay. For example, you want to buy a building in December. Okay. But you saw the building in September itself. You went there, you saw the building, and you liked the building very much, and you want to buy the building. Okay. And you talk to the owner saying that you'll be paying token amount now in September itself, which is nothing but 5 lakh. The cost of the building is 50 lakh. Okay. Cost of the building is 50 lakh. And you said that you will be paying only 5,000 as a token amount. And you'll be telling the owner that you will be paying 50 lakh in December itself. Okay. So that 5 lakh here is nothing but a premium or token or advanced amount which you have paid to the owner to reserve the product. Here product is nothing but the building. To reserve that building on your name, to register that building on your name in December, uh, you have paid the premium or advance amount to the owner. Okay. So this 5 lakh is premium or advanced amount here in our example, and 50 lakh is strike price, and you need to pay that amount in December. Okay. So when you are in December, if you want to avail, if you really want to buy the building, then you need to pay 50 lakh and avail the benefit. Nothing but you'll own the building. For example, in October or November, imagine that your family met with an accident and all your money went for medical expenses, and you don't have 50 lakh now to buy the building in December. Okay. In that scenario, if you don't want to buy the building, you just lose the premium. Nothing but the 5 lakh which you have paid in September will be lost. That won't be given back to you. Okay. So you just lose the premium and say to the owner, say, you will call up the owner and say that I don't want the building. I'm in debt. Okay. So in first scenario, you wanted to buy the building. So you paid 50 lakh in December and you owned the building. In second scenario, you don't want to, I mean, you're not able to buy the building. So you lost the premium and told the owner that you don't want to buy the building. Okay. So in both scenarios, in these two scenarios, you'll be losing the premium, which is nothing but 5 lakh, which is paid in September. Okay. This 5 lakh is nothing but that amount will be just used to reserve the product till December. Okay. All right. I'll be explaining about options with stock or index examples in next few minutes. Okay. Hope you guys are very clear with the example. All right. Thank you. Types of options. This is important. This is important. Types of options. There are two types of options. Okay. The first one is call option and the second one is put option. Okay. I repeat, there are two types of options. The first one is call option and the second one is put option. PUT, put option. All right. Look at this slide. There are two types of options. First is call option and second one is put option. Okay. So market outlook according to calls and puts. Okay. Don't worry. You'll get, I mean, you will understand everything at the end of the session. Okay. You'll get a clear view on what is a call, what is a put, and what we need to do if market is going up, what we need to do when it is going down, what we need to do when it is going sideways. Okay. You'll get everything at the end of the session. Okay. Just stay excited. All right. Market outlook according to calls and puts. It's very simple. See. All right. Call option is represented as CE. Okay. Call option is represented as CE and put option is represented as PE. Okay. And CE is nothing but call European and PE is nothing but put European. I repeat, call option is represented as CE and put option is represented as PE. And CE is call European. Okay. And PE is put European. Okay. And we trade European style. That's why it is represented as CE and PE, which is nothing but call European and put European. Okay. We trade European style. So they are represented as CE and PE. Okay. CE is nothing but call European and PE is nothing but put European. Okay. Do you want me to show in Zerodha? Like, look at this. Look at these strike prices. Are you able to see this? CE, PE, CE, PE, CE, PE, PEC. They are all nothing but call option. I mean, call European, put European, call European, put European. C is nothing but call European, P is nothing but put European. C is nothing but call European, P is nothing but put European. Okay. So these are calls and puts. The calls and puts are nothing but different types of options. There are two types of options, which are nothing but call option, put option. Okay. Call option is represented as CE, put option is represented as PE. CE is nothing but call European, PE is nothing but put European. Okay. Pretty simple. It's very simple. Okay. All right. So market outlook according to calls and puts. This is very important slide. Okay. So bullish view. Imagine that you made an analysis and your analysis is saying that the market will move upward. The market will have bullish. I mean, you are bullish. Okay. You made analysis and you are estimating that the market will move upwards from that point. Okay. In that scenario, what do you need to do? You need to buy call option or you can sell put option. I repeat, this is very important. If you are bullish, you need to buy call option or sell put option. These both are same. Okay. If the market is bullish, if you are bullish, I mean, in equity, what do? You just buy. Imagine if Tata Motors is going upward. If you are bullish on Tata Motors, what do you do? You just buy Tata Motors equity stocks, right? Similarly, if you are dealing with options, if you are bullish, you need to buy call option or sell put option. They do same job. Okay, buy call or sell put, similar, they are pretty similar. Okay, when you are having bullish view, buy call or sell put. If you are having bearish view, you made an analysis and your analysis is saying that market will fall down from that point, then if you are dealing with options, then you need to buy put or sell call. I repeat, if you are bullish, you need to buy call or sell put. If you are bearish, you need to buy put or sell call. I repeat once again, if your view is bullish, if you are dealing with options, then you have two choices. You can buy call or sell put. Okay. If your view is bearish, if you are expecting the market to fall from that point, if you are dealing with options, then you have two options. Okay. You can buy put or sell call. Okay. If you're bullish, buy call or sell put. If you're bearish, buy put or sell call. They are pretty same. They do the same job. Okay. All right. Similar. Now see, here comes the very important point. Option buyer. If you are a buyer, you will get right to buy. Okay. Now see, option buyer. Here, look at this word buyer. If you are a buyer, you will get right to buy. Okay. But if you're buying call option, what I told in previous slide, if you're buying call option, buy call. If you're buying call option, nothing but you're bullish, right? You're bullish. Look at this scenario. If you are buying call option, then you will get the right to buy. You are having bullish view. Okay. Uh, okay. I'll make it very simple. See, if you are an option buyer, you will get right to buy or right to sell. Okay. Buyer will have right to buy and right to sell. And seller, option seller will have obligation to sell or obligation to buy. Okay. Remember, only remember this thing. Only buyer will get right and seller will have obligation. Okay. I'll make it very simple. Buyer will have right, seller will have obligation. Look at this scenario. Option buyer is having right to buy or right to sell. Okay. But option seller is having obligation to sell or obligation to buy. To make it very simple, buyer will have right and seller will have obligation. Okay. So now see, if you are a buyer, buy call, bullish view, buy put, bearish view, sell call, bearish view, sell put, bullish view. Okay. Don't get confused. Go to previous slide. It's very clear here. Okay. If you're bullish, buy call or sell put. If you're bearish, buy put or sell call. Okay. Simple. So if you are buyer, you will get the right. If you are seller, you will get the obligation. Okay. Having right is very important few times, and having obligation is also very important few times. Okay. I'm gonna explain. I'm gonna tell you the difference between option buyer and option seller, and also difference between right to buy and right to and obligation to sell. Okay. I'm gonna talk about differences between right and obligation, and also option buyer and also option seller in later sessions. Okay. So if you're an options buyer, you will get the right. If you're option seller, then you will get the obligation. Okay. So buy call or sell put when you're bullish, buy put or sell call when you're bearish. That's pretty simple. Okay. Now, yes, here are the difference between call option and put option. Okay. Buyer of call option, bullish view. What I told, buy call when you're bullish. Okay. Buyer of call option will have bullish view. Buyer of put option will have bearish view. Okay. Now option buyer can also be called as option holder. Okay. Here also, what you're doing, buyer of put option, you are buyer. If you are buyer, you will have the right. Okay. So you will buy puts when your view is bearish. You will buy calls when your view is bullish. Okay. Option buyer can also be called as option holder, and option buyer can also called as option holder. It's the same. Okay. And call option buyer has right to buy. I already told. Look at this word, buyer. Buyer will have right to buy. Look at this thing, buyer. Buyer will have right to sell. Here he is having right to sell because he is buying put option. If you're buying call option, you will have right to buy. Okay. And seller of call option. If you are selling calls, that means you are having bearish view. Okay. And option seller can also be called as option writer. I repeat, option buyer can also be called as option holder. Option seller can also be called as option writer. Okay. And the seller of put option. If you are selling put options, then you're bullish. You are having bullish view. If you are having bullish view, you can sell put option or buy call. Okay. And option seller can also be called as option writer. Okay. Now, call option seller holds, I already told you. If you are a seller, you will have obligation. Here also, if you are a seller, you will have obligation. Okay. But if you are seller of call, you will get obligation to sell. If you are seller of puts, then you will get obligation to buy. Okay. I know it's very confusing, but you will get more clarity at the end of the session and in upcoming sessions. Okay. Don't get tensed. Don't get emotional. Okay, cool. You will get more confidence moving forward. Okay. I guarantee you pretty smooth onboarding. Okay. So let's get back to this slide. Just remember this thing. If you are bullish, buy call or sell put. If you are bearish, buy put or sell call. Okay. And remember this thing. If you are buyer, you will get the right. If you are buyer, you will get the right. If you are seller, you will get the obligation. If you are seller, you will get the obligation. Okay. But the difference is, if you are buyer of call, you will get right to buy. If you are buyer of put, you will get right to sell. If you are seller of call, you will get obligation to sell. If you are seller of put, you will get obligation to buy. Okay. No need to remember this thing. It's not very important. And yes, that's what I have segregated here. Okay. If you're bullish, buy call. If you're bearish, buy put. Okay. And buyer will have right, seller will have obligation. Okay. And option buyer can also be called as option holder, and option seller can also be called as option writer. Option seller can also be called as option writer. Option buyer can also be called as option holder. Okay. All right. Here comes the important things. Nothing but exercising call option, lapsing call option, exercising put option, and lapsing put options. Okay. Simple. So exercising call option. What is exercising call option? Pretty simple. Look at this scenario. Suppose you have right to buy 100 shares of Tata Motors at 150 per share after 2 months. Okay. Imagine that you have right to buy 100 shares of Tata Motors at 150 per share after 2 months. Okay. Imagine that the current price is 90 rupees. Premium paid is 15 rupees. Imagine that to buy this right, I already told you that while signing options contract, you will get the right only after paying the premium. Okay, that's what I told, right? Similarly, to have this right to buy, to have this right to buy 100 shares of Tata Motors at 150 per share after 2 months, you need to pay the premium. Okay, the premium paid here is 15 per share. Okay, and amount required to buy call option is amount required to buy call option is 15, which is nothing but premium, into 150 rupees, nothing but the price at which you are ready to buy. Okay, 15 into 150, nothing but 2250. Okay, suppose Tata Motors share price is 200 after 2 months. You bought Tata Motors at 150 only. Now Tata Motors share price is 200 here after 2 months. Okay, then you can exercise your call option and profits will be current price minus 150 into 100 shares, nothing but 5,000. Okay, but net profit is nothing but 5,000 minus paid premium. I already told you that you will be losing premium in both scenarios, whether the price is moving up or moving down. Okay, so from your profits you need to subtract your premium. Okay, so 5,000 minus 2250, which is nothing but 2750, will be your profits. So exercising call option is also called as in the money. Okay, just remember that word. I'm going to talk about in the money, at the money, and out of the money in later sessions. Okay, I repeat, suppose you have the right to buy 100 shares of Tata Motors at 150 per share after 2 months. Okay, the current price is 90 and premium paid is 15,000. Why do you pay the premium? To sign options contract. Why do you sign options contract? To get the right. If you're having the right, you can sell them at higher price. In our farmer example, he signed options contract to sell vegetables at 5,000, but price went to 7,000 on 31st December. If he is signing options contract, then he will get the right to sell them at 7,000. Okay. Similarly, here in Tata Motors, if share price, I mean, you signed a contract saying that you will sell Tata Motors 100 shares of Tata Motors at 150 per share after 2 months. Okay. But after 2 months, if share price goes to, if share price goes to uh, 200 from 150, what can you do? Because you have signed options contract, because you have paid the premium, you will get the right. If you're having the right, you can sell them at 200. But if you're signing forwards or futures options, you cannot do that. You need to sell them at 150 price only. Okay. Because you have paid the premium, because you have signed options contract, you will get the right. If you're having the right, you can sell them at 200 to book profits. Okay. So similarly, suppose that Tata Motors share price is 200 after 2 months. In our example, uh, current price of vegetables on 31st December is 7,000 there. Okay. Here Tata Motors share price is 200 here after 2 months. Okay. Then you can exercise your call option and profit will be 200 minus 150 rupees. Okay. 200 is current market price and 150 is at which you have signed your contract to buy them. Okay. So 200 minus 150 into 100 shares, nothing but total profit will be 5,000. But net profit is nothing but you need to deduct premium paid, nothing but 5,000 minus 2250, which is 2750. Okay. So exercising call option is also called as in the money. Just remember this word in the money. I'm going to talk about in the money, at the money, and out of the money in later sessions. Okay. So that's all about exercising call option. It's pretty simple. Now let's consider opposite thing. In this example, share price of Tata Motors went to 200. Let's consider what happens if the share price of Tata Motors comes down from 150. In exercising call option example, in that example, Tata Motors share price went from 150 to 200. Let's see what can happen if the Tata Motors share price is coming down from 150. Okay, so lapsing the call option. Okay, that talks about what if the share price comes down from 150. Okay. And same example, suppose you have the right to buy 100 shares of Tata Motors at 150 per share after 2 months. Okay. Current price is 90 and premium is 15 rupees per share. So amount required to buy call option is 15 into 150. 15 is nothing but per share into, you told that you will be buying 150 per share, right? So 150 into premium is 15. So 150 into 15, 15 into 150, nothing but you'll just need 2250 to buy call option. Okay. And sign the contract. That's the premium you have paid to sign call option. Okay. Now, suppose Tata Motors share price is 110 rupees after 2 months. From 150, it came to 110. Okay. So if you are signing forwards and futures contract here, what will happen? You will be at profit, right? You'll definitely at profit because you signed a contract saying that you will be selling them at 150 only. So you cannot go against the contract. You should sell them at 150. Okay, but the current price is 110 only. You will get 40 rupees profit here. According to our farmer and shop owner example, uh, farmer signed an agreement saying that he'll sell his vegetables at 5,000 on 31st December, but the current market price or the current value of those vegetables is only 4,000. Imagine that the current value of those vegetables is only 4,000. Okay, even though the value of the vegetables is 4,000, the farmer will sell them at 5,000 to the shop owner because he has signed forward or futures contract. When it is coming to options, he can also do the same, but in this scenario, he'll be losing the premium which he has paid. Okay. So similarly, in Tata Motors, if share price is coming down to 110 after 2 months, then you can lapse your call option and profits will be 150, nothing but which you have signed an agreement at that price, which is nothing but 150 minus 110 current market price into 100 shares, nothing but 4,000. Okay, so net profit will be 4,000 minus paid premium. I told you that whatever the situation is, you will be losing the premium. So you need to subtract the premium from your profits. Okay, so 4,000 minus 2250, nothing but 1750. Okay, so you will be in profits of 1750 if you are lapsing your call option, even though the price is going down. Okay, so lapsing call option can also be called as out of the money. Exercising call option is called in the money. Look at this last line. Exercising call option is also called as in the money. Lapsing call option is also called as out of the money. Exercising call option in the money. Lapsing the call option out of the money. Okay, I'm going to explain you about in the money, at the money, out of the money with in a very simpler format in upcoming sessions. Okay, don't worry about that point. Just leave that point aside. I'm going to explain you about all these things in upcoming sessions. Okay, for now, only think about exercising call option and lapsing call option. When do you exercise your call option? In our farmer and shop owner example, if the value is if you have signed an agreement saying that you will sell vegetables at 5,000, and if the value of the vegetables on 31st December is 7,000, then you will exercise the call option. Okay, in here in our example, when if the Tata Motors price is 150 rupees and you have signed an agreement saying that you will be selling Tata Motors 100 shares of Tata Motors 100 shares of Tata Motors at 150 per share after 2 months. Okay, but after 2 months, what happened? It went to 200 rupees. Okay, so if you're signing options contract, you will get the right to sell them at 200. Okay, instead of 150. So that difference will be your profit, and you need to subtract your premium. Okay, that is exercising call option. Lapsing call option is nothing but what if the value is coming down from 150? If the Tata Motors price is coming down from 150 to 110 only, in that scenario also, you will be in profits. Okay, so you are in profits in both the scenarios by exercising call option and by lapsing call option. Okay, so now let's look at what is exercising put option. Pretty similar, but it's opposite scenario. Okay, so in this scenario, suppose you have right to sell. In previous example, you had right to buy. When you're dealing with call options, you will get right to buy. When you're dealing with put options, you will get right to sell, the power of right to sell. Okay, suppose you have right to sell 100 shares of Tata Motors at 150 per share after 2 months. Current price is 90 and premium paid is 15, and amount required to buy put option is 150 into 15, nothing but 2250. Okay, suppose Tata Motors share price is 70. Oh my god, from 150 it came down to 70 after 2 months. So you can exercise your put option here, and profits will be 150 minus 70 into 100. 150 is the price at which you have agreed to sell, but the current price is 70. Okay, 150 minus 70 into 100 shares. So your profits will be 8,000, but from that 8,000, you need to subtract the premium which you have paid, nothing but 8,000 minus 2250. So 5750 will be the overall profits, net profits. Okay, so I'm so sorry. This is exercising put option. Okay, exercising put option is called in the money. Okay, all right. I mean, the example is very I mean, exercising call option and lapsing call option, exercising put option and lapsing put option, they are pretty similar. They're pretty similar. I mean, if the market price is moving upward, you will exercise your call option. If it move coming down, if it is coming down, you will lapse your call option. Okay. In this example, what happened? You are exercising put option. If you're dealing with put option, you will get the right to sell. Okay, so you have paid the premium, signed options contract saying that and you own the right to sell of 100 shares of Tata Motors at 150 per share. Okay, so suppose Tata Motors share price is 70 rupees after 2 months, then you can exercise your put option and profits will be 150 minus 70 into 100 shares, which is nothing but 8,000, and from that 8,000 you need to subtract the premium which you have paid to buy call option, sorry, to buy put option. So 8,000 minus 2250, which is nothing but 575. 5,750 rupees is overall profit. Okay, and exercising put option, excuse me for this mistake, it is exercising put option. Exercising put option is also called as in the money. Okay, so what is lapsing put option? Opposite of exercising put option, it's the same. In this scenario, the price moves upward from 150. Okay, so suppose you have right to sell because you're dealing with put options. Okay, so suppose you have right to sell 100 shares of Tata Motors at 150 per share after 2 months. Okay, current price is 90. Okay, premium paid is 15 per share. Okay, so amount required to buy put option is 15, which is nothing but premium per share into 150 per share. Okay, you want to sell them at 150 per share, so 15 into 150 is nothing but 2250. Okay, suppose Tata Motors share price is 210. I mean, it went from 150 to 210 after 2 months. Okay, then you can lapse your put option, and profits will be 210 minus current market price minus 150, the price at which you have agreed to sell. Okay, 210 minus 150 into 100 shares, nothing but 6,000. So net profits will be 6,000 minus paid premium. I mean, the premium which you have paid will be lost in both the scenarios. So 6,000 minus 2250, nothing but 3,750 is the overall profits, net profits. Okay, all right. So lapsing put option, this is not call option. Lapsing put option is also called as out of the money. Okay, and let me revise. What is exercising call option? Very simple. Tata Motors, I mean, Tata Motors current market price is 90, but you are expecting that it will be bullish. Okay, you're agreeing that you're gonna buy 100 shares of Tata Motors at 150. Okay, imagine that it went till 200, but you signed an agreement saying that you'll buy 100 shares of Tata Motors at 150 only. Okay, imagine that it went till 200. Okay, it was even more bullish. In that scenario, you'll get the profit of that 50 rupees. 200 minus 150, that 50 rupees. Okay, minus you need to subtract the premium which you have paid. Okay, so this type of scenario is called exercising call option. A lapsing call option is nothing but, so if the Tata Motors price went down from 150 to 110. Okay, in this scenario, you're gonna lose 40 rupees. Sorry, you're gonna gain 40 rupees here as well. Okay, because by signing options contract, you will get the right. If you're having the right, you can sell them at 150 only. Okay, so even though the current market price is 110, you're gonna sell them at 150 only. If you're selling them at 150, you'll be in profits of 40 rupees. 150 minus 110. Okay, so in that for 40 rupees, you're gonna subtract the premium which you have paid to get that right. Okay, then that will be your profits. The remaining amount will be your profits, and such type of thing, I mean, this type of making profits is called lapsing call option. Okay, and exercising put option, pretty similar. In exercising put option, you'll get right to sell. Okay, you'll get right to sell 100 shares of Tata Motors at 150 per share after 2 months. Imagine that the price went down to 90 rupees or 70 rupees. Okay, so the difference will be your profits here as well, because you have the right, and you need to subtract the premium which you have paid, so you will be in profits there as well. Okay, imagine that the price went up above 150 rupees. Okay, in that scenario also you will be in profits. Okay, you need to just calculate the difference and subtract your premium amount which you have paid to get that right. Okay, so when you're dealing with options, you can be more profitable if your view is right. Okay, so I mean, if your view is right only to some extent. Okay, all right, you'll get this when you're moving forward. Okay, so that's all about exercising call option and lapsing call option. And one more thing, exercising call option is called in the money, and lapsing call option is called out of the money. Exercise input option is called in the money, and lapsing put option is called out of the money. Okay. Now let's talk about payoff diagrams. Payoff diagrams. It's very important. I'm going to show you. So this is obstra.defineedge.com. Okay. So this is a strategy builder. This is free for everyone. So you can just go to Google and type obstra.defineedge.com. You can sign in with your Gmail address and use this. Okay. This is very important. And let's imagine Nifty is an index, right? Nifty index. Okay. Let's select Nifty index. And no, we are dealing with options. So select options here. And this is expiry day, 24th December. Okay, let's deal with 31st December. Okay, 31st December. And strike price. Let's choose 13,800. Okay, and call. C is nothing but call option. Okay, and buy. What I'm doing? Buy, call. When will I do buy call? When do I buy call? When my view is bullish. Okay, now see, I click on add position. Immediately after clicking on add position, I'll get this diagram here. Okay, this diagram is nothing but payoff diagram or payoff chart. Look at this heading, payoff chart or payoff diagram. Okay, so when you buy call, that is nothing but your view is bullish, then you'll see this diagram once you click on add position. Okay, now see, it will show you what can be your maximum loss and maximum profit. Okay, look at this scenario. Your maximum loss can be only 6,442. Imagine before 31st of December, if Nifty 50, this Nifty is nothing but Nifty 50, if Nifty 50 is below 13,800, then I'm going to lose 6,442. For example, before 31st of December, if Nifty 50 is crossing 13,800 and moving upward towards 14,000 or some, what is the current price of Nifty? Nifty 50. It's 13,750. Okay. So imagine that before just imagine that I'm pretty sure that I have made an analysis and saying that Nifty 50 will cross 13,800 before 31st December. Okay. So for that, I'll be select the expiry as 31st December, and I'll say that Nifty 50 will cross the 13,800 before 31st of December. Okay. So I'll buy call. But why I'm buying call? Because I am bullish. Why I'm bullish? Because I'm expecting that market will cross 13,800 before 31st of December. Okay, so I have buyed call. Now I have clicked on add position. After clicking on add position, I'll get this payoff chart. Okay, so now here I can check that what can be the maximum loss and maximum profit that I will get. Okay, now look at this x-axis. X-axis says that I'll be in loss. The maximum loss is minus 6,442 rupees. Okay, if Nifty 50 is not crossing 13,800 before 31st of December, I'm gonna lose only 6,442 rupees. Okay, imagine that Nifty 50 has crossed 13,800 before 31st of December. Okay, in that scenario, look at my profits. The more the market moves towards upward, the more profits I get. Okay, look at this x-axis: 13,996, 14,320, 14,600. Once it is crossing 13,800, which I have entered the position saying that I said that market will cross 13,800 before 31st of December. If it's crossing the 13,800 before 31st, the more upward it moves, the more profits I get. Look at P&L on the screen. 13,000, 14,000, 15, 16, 22. The more it moves upward, the more profits I get. Okay. If it is moving to 15,000 before 31st of December, then I will be in profits of 84,608 rupees. If it's moving to 14,318 before 31st of December, I'll get 32,408 rupees as profit. Okay. But what happens if market is not moving? I mean, what happens if market doesn't cross 13,800 before 31st of December? What happens? I'll be losing only 6,442. Okay. In this scenario, my loss is limited, which is only 6,442. Okay. But my profits are unlimited. The more the market moves towards upward, the more profits I get. Okay. So that is about buying call. Okay. And if you are bearish, oh, all right. Okay. Let's talk about bullish scenario. If you're bullish, you can buy call or sell put. Yes, you are right. You can buy call or sell put. Okay. Let's sell put. I have selected PE because it's put, which is nothing but put European. So I'm going to sell put. If your view is bullish, you can buy call or sell put. Till now, I have explained the scenario about buy call. Now I'll explain the scenario about payoff chart about sell put. Okay. So I have selected sell here and selected put here. All right, before that, I should be deleting this scenario, the previous example scenario. Delete. Okay, so sell put. I have I have added position of selling put. Okay, now in this scenario, I am bullish here because when I am bullish, I can buy call or sell put. Now I am selling put, so I am bullish here again. Okay, so saying that market will cross Nifty 50 will cross 13,800 before 31st of December. Okay, so if my let's check my P&L report if my view is right, and let's check my P&L report if my view is wrong. Okay, so for that, this is the payoff diagram. Now look at this scenario. So imagine that the market moved upward. Nothing but imagine that the market has crossed 13,800 and went to 13,900, 14,000 or 14,500, etc. before 31st of December. Okay. In that scenario, look at my profits. Look at this x-axis. X-axis says that the price movement in Nifty 50. Nothing but for 13,684, 14,000, 14,300, 14,600, etc. Okay. Even though it's moving more, I mean, the more it moves, I won't be getting more profits if I am selling put. Okay, my profits are limited when I am dealing with selling puts. See, even the market is moving to 13,806 rupees. My profit is 9259. Even though it is moving to 14,347, look at the x-axis. Even though the Nifty 50 is moving to 14,347, my profit is limited. It's again 9259 only. Even though if the market is moving to 14,853, my profit is limited here because I'm selling put here. Okay, like I told, if you are buying, you will get the right. If you are selling, you will get the obligation. So when you are having obligation, your profit is limited. When you are having the right, your profits are unlimited. You will get the right when you buy. You will have the obligation when you sell. Here I have sold. I'm so sorry, guys. I repeat, when you buy, you get the right. If you're having the right, your profits are unlimited. Okay. When you sell, you will get the obligation. When you're having the obligation, your profits are limited. Okay. Even though the market is moving to 20,000, 25,000 or 50,000, your profits are limited only because you're doing selling. If you're selling, what will have you will have the obligation. If you're having the obligation, your profits are limited. Look at this payoff diagram. See, the market is look at this. Look at the x-axis. The market is at 13,806. Okay. Look at the P&L report. It's 9259. Okay. Now I'm moving forward. Imagine that the market has moved to 14,000, 14,011 rupees. Even though my P&L shows that I'll be in a profit of 9259 only. Okay, because I'm doing selling here. If I'm selling, I'll get the obligation. If I'm having the obligation, my profit is limited. You will get right only when you buy. If you're a buyer, you will get the right. If you have the right, your profits are unlimited. Now look at this scenario. Imagine that the market is moving down. It is going down to 12,700 or 13,000 or 12,900 or some 12,500, etc. Okay. The more the more it moves down, your loss will increase. Loss is unlimited here. If it is going down to zero, your loss will also increase here. Look at P&L report. It says that minus 30,000, minus 40,000, minus 49,000, minus 50, 60, minus 8, 70, 80. Okay. The more market moves down, more will be your losses, because you sold. Okay. If you are selling, you will get obligation. If you're having obligation, you'll have unlimited risk and only limited profit. Okay. So that's about bullish view. Now let's get into bearish view. Okay. So for bearish view, imagine that, let's consider 13,300. Okay. So imagine that the current market price of Nifty is 13,749. Okay. Here it is. Nifty 50, 13,740. Okay. 13,740 is current Nifty 50 price. Okay. Imagine that I am bearish. Okay. Just imagine. I have made an analysis and I'm expecting that market will fall. Okay. If I'm bearish, what can I do? I can buy put or sell call. Okay. Now say I am buying put here. I have selected buy and PE. Okay. PE is put European. I'll buy put if I'm bearish or sell call. Okay. If I'm bullish, I'll buy call or sell put. If I'm bearish, I will buy put or sell call. Okay. If you're a buyer, you will get the right. If you're a seller, you will get the obligation. Yes, you're on it. You're right. Okay. All right. Now see I am bearish. So I'll buy put or sell call. So let's look at buying put scenario. Here I am buying. So before that, I will delete this old position and I'm gonna add buy put position. All right, look at this scenario. If the market is moving down, look at this scenario. What did I say? I am bearish and expecting that. All right, it's 13,300. Okay. 13,300. And now I'm expecting that if the imagine that I am bearish and I'm expecting that market will fall below 13,300 before 31st of December. I repeat, imagine that I am bearish and I'm expecting that market will fall below 13,300 before 31st of December. Okay, if I'm bearish, I can buy put or sell call. So let's look at buy put scenario. Buying put. Okay, add position. Okay, let's look at this scenario. Now, imagine that market is moving downward. Look at this scenario. Look at X axis here, 13,000 and 12,699 and 12,376. Okay, look, the more market moves down, the more profit I get. Look at my profits, 14,000, 22,000, 36,000 when market is at 12,794. 52,000 when the market is at 12,578. Okay. So if you are bearish, if you want the right, if you want the unlimited profit, you should buy puts. Okay. See, the more market moves down, the more profits you get. Okay. From 13,300. See, I repeat, I am bearish and I'm expecting that market will move down below 13,300 before 31st of December. So I am buying put. If I am buying put, my loss is limited here because I am buyer here. When I am buyer, I will have the right. If I'm having the right, My loss is limited, my profit is unlimited. Look at my loss. My loss is only 1,515. That's very less. See, even though my view is wrong, if market is moving towards upward, look at the x-axis from 13,600 to 13,900 or 14,000 or 14,600 or 14,900 or 15,000 or 20K, 30K. So whatever, I mean, if my view is wrong, I'll be losing only 15,500. My loss is limited here if I am buyer. Okay. If my view is right, the more market moves down, the more profits I get. Okay. So that's about buying put. So what can I do if the market is bearish? I can buy put or sell call. Okay. Let's look at selling call scenario. I have selected CE and sell. Okay. Now see, I'm expecting that market will move down below 13,300 before 31st of December. Okay. For that, I can buy put or sell call. Okay. So in previous example, I have explained you about buying puts. Now I'll explain you about selling call. Okay. So I have selected CA here and I have selected sell here and I'm clicking on add position. Let's look at payoff diagram. This is payoff diagram or payoff chart. Now look at this scenario. Here, look at my profits. My profits are limited here. I won't be getting more than 36,000. Oh, there is something wrong. Let's delete and add again. Add again. CE sell 31st December 13,003. Add position. Okay. All right. So now see what I told. I am bearish and I'm expecting the market will go below 13,300 before 31st of December. Okay. In that scenario, if it's moving down, I'll get only 36,128 rupees, not more than that. Even though if it's moving to 13,000 or 12,000 or 10,000 or 100 or zero. Okay. From 13,300, if it's moving down to zero also, my profit is limited here. I'll get only 13,128. Okay. But if my view goes wrong, if market moves to 14,000 or 14,300 or 14,600 or 14,992, look at my losses. 12,000, 15,000, 20, 42K, 50K, 65K, 70K. Okay. The more bullish the market is, the more losses I will face. Okay. Here, profit is limited and loss is unlimited. See, what did I do? Sell. If you are seller, you won't get the right. You will get the obligation. If you are getting the obligation, that means your profits are limited and loss is unlimited. Look at this scenario. Your loss is unlimited. My view is bearish. I'm expecting the market will go down below 13,300 before 31st of December. Okay. If that doesn't happen, if market moves towards upward towards 13,900 or 14,200 or 14,600, if it moves towards upward, if it move towards upward, I'll be losing more and more. My loss is unlimited here. But if my view is correct, if it's moving downward as I expected, I'm expecting that it will move below 13,300, right? So if it's moving down to 0, 100 or something else, even though if it's moving down to 0, my profit is limited here. I will not get more than 36,128 rupees. Okay. So if you are seller, you will get the obligation. If you are having the obligation, you will get limited profits and you will have unlimited loss. Okay. If you are buyer, you will get the right. If you are having the right, you will have unlimited profits and limited loss. Okay. So if you're bullish, you will buy call or sell put. If you're bearish, you will buy put or sell call. Okay. If you're buyer, you will have the right. If you're seller, you will have the obligation. Okay. If you're buyer, uh, if you're buyer, you will get the right. If you get the right, your profits are unlimited and loss is limited. If you're seller, you will get the obligation. If you're having the obligation, your profit is limited and loss is unlimited. Okay. Just keep those things in your mind. I'm pretty sure that most of the people here got when you will get a limited loss, when you will get unlimited loss, when you will get a limited profit and when you will get unlimited profit. Okay. So I'm expecting that you guys are very clear when to buy call, when to buy sell. I mean, when to buy call or buy put, when to sell call or sell put. Okay. If you're unclear, no worries. I'm going to explain the same example. I'm going to explain the payoff diagrams again in upcoming sessions with much more enthusiasm. Okay. So, like I told, I'm going to simplify things in much more better way in upcoming sessions. Okay. I'll make it very clear to you guys in upcoming sessions as well. If you're unclear, okay, you can ask me your doubts. You can message me at any time. Okay. I'm going to talk to you. I'm going to explain you each and everything in a very detailed manner. Okay. I repeat, if you're bullish, you should buy call or sell put. If you're bearish, you should buy put or sell call. Okay. If you're an option buyer, you'll get the right. If you're getting the right, that means your profit is unlimited, loss is limited. Okay, profit is unlimited, loss is limited if you're option buyer. If you're option seller, you'll get the obligation. If you're having the obligation, nothing but your profit is limited, but your loss is unlimited. Okay, so just keep these things in your mind. You'll get more and more quality. I mean, more and more quality teaching and more uh, clarity going down the line. Okay, uh, you'll get more and more clarity in upcoming sessions. Okay, I'm pretty sure that most of the people here got, I mean, most of the people understood what I have taught till now. Okay, so guys, please like this video and subscribe to our YouTube channel. Thank you guys. Thanks a lot. Thank you everyone.